Surging container freight rates and port congestion, refloating the Dali in Baltimore. Is more consolidation in offshore marine to come? Just some of the topics we'll be discussing in this episode. Hi, it's Marcus Hand, editor of Seatrade Maritime News here with our main news roundup, Maritime in Minutes, and I'm joined by our correspondent, Gary Howard. We've got a lot to get through in our May coverage, so let's jump right into it with Gary talking about container freight rates and the Cape of Good Hope diversions, which is something of a recurring theme as supply chain disruption and port congestion reared its head again. Gary.
Thanks, Marcus. Yes, first up was a story on container contract negotiations and the difficulties in putting a price on the current market situation. Marcus highlighted this in a story on the Trans-Pacific trade in particular, where shippers and container lines have had very different ideas on what a fair price is for moving containers over the ocean. The difference of opinion is down to the difficulty in balancing the effects of diversions around the Cape of Good Hope, which is soaking up a lot of tonnage very effectively, and the structural overcapacity in container ships, which continues to be fed by new ship deliveries. An improvement in the Red Sea and resumption of Suez Canal transits could change market dynamics in a very short period of time for container operators. These negotiation periods are always a time of tension, and I expect shippers were looking forward to finally having the upper hand in negotiations this year before the Red Sea crisis brought so much support for box rates. Demerco Express Group reported some retailers are finalising contracts at 12 to 17% over last year on their eastbound contracts. Paul Bartlett had a piece a couple of days after Marcus's piece showing a similar trend beyond the Transpac trades, with a Zanetta analyst saying lines were balancing the risk and reward of higher rates and securing longer-term volumes. Just do a quick search for contracts on Seatrade Maritime News and that should bring that one up as well. Over to you, Marcus.
Yeah, that's something we're going to be coming back to a bit all around the container freight rates and spot rates as well later in this episode. But for week one, I'm turning my attention to alternative fuels. Classification Society DNV does an excellent job tracking new building orders for vessels that have alternative fuel capabilities and which types of fuels they will be equipped to handle. Its Alternative Fuel Insight platform logged 23 new orders in April, of which the largest portion came from methanol, with 12 vessels contracted, and 7 LNG fuel vessels. So LNG still continues to be quite important, despite concerns of, the fact that it's not a truly green fuel. A growth in methanol-fueled tankers was noted, a sector that had previously seen very little activity, although to be fair, it seen very little new building activity of any kind. There was also orders for 4 ammonia-fueled vessels, underscoring a pickup in activity around that nascent fuel type. Overall, the trend for new building orders with alternative fuel capabilities continues to be on the up. The AFI platform tracked 93 new building orders in the first 4 months of 2024 with alternative fuels capabilities. That's an increase of 48% year on year. Methanol was the fuel of choice of those, accounting for 47 of the new orders in the first 4 months of the year, and we will continue to track this as the year goes on. If you're enjoying the Seatrade Maritime podcast, make sure you never miss an episode by subscribing on the app of your choice. Gary, over to you for week 2.
Yeah, my second week pick is a markets piece from our man in New York, Barry Parker, and this is on tanker trades. The first quarter earnings report from listed tanker companies showed their good fortune continuing, generally meeting and beating expectations. Barry writes that tanker owners are deleveraging, reducing and improving their debt commitments. International Seaways gets a glowing write-up for its investor-friendly activities and for delivering earnings per share well above the forecasts ahead of the release. Time charter equivalent earnings for its fleet were looking even stronger for the second quarter as well, with VLCC's earnings up around 10% on what they got in the first quarter. Barry picks out some performance metrics from other listed tanker operators as well, including charting the rise of stock prices since the start of the war in Ukraine a couple of years back, an event which was the catalyst for tanker market strength as it upended global energy trades. The bull market comes down to the fundamentals really of higher demand and longer voyage distances, and there are no clear signs of that changing in the near term. Marcus?
Yeah, I'm going to actually be staying with a US listed company. For the second week of the month, I'm turning my attention to offshore vessels, a market that is on the up after an extremely lengthy downturn that started in 2014. Anyone who follows offshore marine will surely be aware of the US headquartered Tidewater Marine, which has been one of the biggest consolidators in that space. I recently had the pleasure of sitting down with Quintin Neame, President and CEO of Tidewater, and talk through its acquisition strategy, which came at a time when many believed the offshore vessels market would simply never recover. Quintin himself joined Tidewater through its merger with the smaller Gulfmark, and then Tidewater went on to acquire Swire Pacific Offshore at a bargain basement price and the PSV fleet of Solstad. Tidewater remains on the acquisition trail, although pricing today is more challenging than it was a few years ago. Quintin says that its focus for M&A is in the Americas, where its previous acquisitions have actually left it relatively underweight. But does he believe it's the right time to order new buildings? Well, click on the link in the show notes to find out. The full conversation is also available as a podcast, giving a broad insight into Tidewater and Quintin's strategies, and it's really well worth a listen. Gary, back to you.
I imagine there are plenty of people in the offshore sectors that still remember just how many ships were laid up for years and years on end. I remember very huge percentages of various global fleets just mothballed for so long. Yeah, week 3, we're back to containers and market fundamentals for me with a piece from Nick Savides. He's picked up on observations from Alphaliner on the actual overcapacity in the container market, which sort of lays beneath this Red Sea crisis impacts. Container lines currently lack the ships to fulfill their major Asia-Europe loops, but if the Red Sea were to open up again, lines would need to find other work for 54 vessels, averaging over 14,000 TEU. This is not accounting for the 2 million TEU of ships due for delivery in this year. Nick spoke to Stefan Verbergmose at Alphaliner, who said that extra tonnage was still welcome on Asia-Europe at the moment, with 9.6% of sailings currently being cancelled due to a lack of ships en routes. Extra tonnage is also required on trades like India, Europe, and Asia, US East Coast, he said. This demand may increase very soon as the sector braces for a pretty strong peak season. So for the moment, lines have restructured their networks and found a way to operate largely without use of the Red Sea. The only way we'll get to test the strength of the market's real foundations is if the Red Sea becomes safe to transit again. But that's something that Maersk said it doesn't expect foreseeable future, so I think we should probably get used to things the way they are. Over to you again, Marcus.
Yeah, I'm going to very much stay with this story, actually, and what's been happening with the container shipping market. And as you said, Maersk saying that he doesn't expect things to go back to the way they were in the foreseeable future. And one of the things that's happened is there's been an unexpected surge in spot rates caused by that lack of ships at present, which Gary was just talking about. Now, earlier in the year, there was a surge in spot rates, but this had actually come off in March and April as it appeared the market had normalized in terms of those diversions via the Cape of Good Hope. However, as lines discussed the current capacity situation in their first quarter results, it prompted fears from shippers about space as we head towards the peak season later in the summer. The result of this has been that if you looked at the 17th of May, the benchmark Shanghai Containerized Freight Index was up some 29.8% on where it had been just 2 weeks earlier. It was a similar picture for Drewry's World Container Index, which rose 11% on the 16th of May over the previous week, following a 16% rise in the week before that. Now, container spot rates have continued to rise over the remaining weeks of May. Analyst MSI said the increases were most likely driven by a combination of ongoing Cape of Good Hope diversions, a stronger than expected demand rebound, and weather delays in major Chinese ports causing a rally outside of the usual peak season. We will be tracking this on Seatrade Maritime News and whether spot rates continue to rise in June, so look out for that on our site.
I was about to say that this is the end of a story that's been running for a while, but it isn't the end at all. It will keep rumbling on. Dali was refloated on the 20th of May, moving for the first time since it struck the Francis Scott Key Bridge in Baltimore on the 27th of March, with the loss of the lives of 6 construction workers on the bridge. Dali's been blocking the main channel into Baltimore's ports, although other channels were opened up to allow smaller vessels to enter and exit the port with permission. We've reported on a lot of activity on the site of the incident since it happened, much of which was in preparation for this refloating. Salvage teams and engineers have been removing sections of the bridge and containers lost overboard for weeks now. And a week or so before the ship was refloated, there were explosive charges set off to remove the critical piece of bridge and roadway that was laying across the ship's bow. The operation to refloat Dali started very early in the morning with the deballasting of over 1 million gallons of ballast water and the release of mooring lines to hand the vessel over to some tug escorts. And then the ship was escorted just a couple of miles along the river to a marine terminal where it remains. Check out the stories on Dali for some interesting pictures of the recovery operation from the US Coast Guard, who have done a great job at keeping everyone updated with what's going on site. And there's also a link through to a video to watch the ship slowly moving away from the remains of the bridge, which is a nice little background video to have on. Over to you, Marcus.
Yeah, there have actually been some fantastic sort of pictures and video from the US Coast Guard of all those operations, and we've been running quite a number of those, and yeah, really interesting to look at. Going to stay stateside with a story from our US correspondent, Barry Parker. And this is on industry reaction to planned new cyber regulations for the maritime sector. The US is concerned that while increased cyber-connected systems improve maritime industry productivity, they also increase the security threat from malicious actors. In February, the US Coast Guard issued a notice of proposed rulemaking regarding cybersecurity for US-flagged vessels, and this has been open for public feedback, and there have been dozens of comments coming in from the industry, including top names like Maersk, industry representative bodies, and smaller independent companies. To just kind of summarize this feedback, it was critical of the level of burden, the practicality of implementation, and the lack of alignment with existing measures. For a fuller explanation of the feedback and the criticism, see the story Shipping Concerned Over Onerous US Cybersecurity Regulations in the show notes. Gary.
Yeah, I actually interviewed, whilst I was out in America, a Rear Admiral from the Coast Guard about their cyber security rules, and that story is in the Seatrade Global Ports Report, if you want to find that one out as well. Just to finish off this month, my favourite pet subject of wind propulsion. MOL Group announced some new orders for wind propulsion systems and revealed a longer-term target for its own wind propulsion product. 7 MOL new buildings are set to get a boost from wind power, with 6 bulkers getting MOL's proprietary Wind Challenger system installed, and a multi-purpose vessel getting 2 of Econowind's vent foils. One thing that jumped from this story for me was that MOL is exploring installing rotor sails alongside its Wind Challenger on 3 of the bulkers. The company says it expects fuel savings of between 7 and 16% for the Wind Challenger alone, and then 15 to 28% for Wind Challenger with a pair of rotor sails on board as well. MOL has first-hand experience with its Wind Challenger. Shofu Maro is a bulker that's been operating with this with fuel savings of up to 17% since it entered service in October 2022. These sorts of fuel savings are hard to overlook, especially with the product of higher fuel costs for alternative fuels in the future. MOL said it's targeting 25 installations of Wind Challenger by 2025 and 80 by 2035, so a real show of confidence there in the technology. Marcus, last one's on you.
Yeah, no, the wind power has really been seeing quite a take-up. We've had quite a number of quite interesting stories on this, and the level of take-up there is, and across different vessel types. I'm going to be talking about something very different. I'm coming back to that whole impact of rerouting from the Red Sea via the Cape of Good Hope for the final story of this episode. The world's largest transshipment port of Singapore is known for its efficient operations, so when container ships start to see delays, it basically makes headline news. According to the analyst Linealytica, box ships have been facing berthing delays of up to 7 days at the port, and with a total capacity waiting at the dock rising to 450,000 TEU recently. That's a pretty hefty chunk of capacity there sitting on the dock. The Maritime and Port Authority of Singapore, MPA, says the congestion is caused by the Red Sea crisis and the diversion of vessels via the Cape of Good Hope, which resulted in off-schedule vessel arrivals and what it described as vessel bunching. Singapore has seen what it also described as a significant increase in vessel arrivals and handled 13.36 million TEU in the first 4 months of the year. That's an increase of 8.8%. To try and alleviate congestion, the Singapore authorities have reactivated berths which had been mothballed at the aging Keppel terminal to increase weekly capacity to 820,000 TEU. That's up 50,000 TEU from what it would normally be of 770,000 TEU weekly capacity. Keppel Terminal, close to the city centre, is actually in the process of being closed down as operations are being shifted to Tuas Port in the far west of the island. And as part of that process, the authorities have accelerated the bringing on stream of 3 new berths to Tuas Port to try and, again, alleviate congestion that is taking place at the moment. Again, a story I'm sure we will be coming back to in the coming months. That's all we've got time for on this episode. If you want to learn more about this and all the stories featured in this episode, links are in the show notes. Thank you for listening, and we look forward to joining you on the next episode of the Seatrade Maritime Podcast.